Good morning, everyone. Welcome to Crow and Happy New Year to everyone. Let's wait for one more minute. Lot of people are enrolling. Great, fine. Let's start this webinar. Good morning, everyone. I'm Binish Shah, partner in the Crow in the advisory division, and I am heading tax and technology. So we are taking care of the lot of clients in UAE for the tax and technology, not only UAE as an international taxation, also we are assisting cross-border clients across the globe. And as you might be aware about, the Crow is since last 41 years in the UAE, catering the clients. More than thousands clients are there. We have a staff of 250 people and having 6 offices across the UAE. So any corner of the UAE, you will find us and you can approach us for that. As everybody is aware about, the corporate tax and transfer pricing is very interesting subject for everyone, and a lot of people are curious about that to know how it is going to apply for their company with the various and different situations, different structure. So we will try to address here with the how it is going to impact on your organization, corporate tax and transfer pricing. So spatially, we have identified a lot of different scenario with the offshore company, onshore and free zone company, mainland company, having a branch, having a separate trade license, having a related, how to define the related party transactions. All this is required and it is need to know by each and every clients because it is directly going to impact 9% to the every business. And that's why we have taken this initiative for the webinar, and possibly webinar we will be coming with the webinar series also there. As you aware about that, the transition of the corporate tax, if you can see this slide, that 31st January, UAE government has declared that corporate tax is going to be launched in UAE. And since then, we are evolving about the corporate tax, how it is going to be applied. We do study for the many countries within the GCC, outside GCC, and Crow as a global firm, we have a expertise for in across the globe, and each and every countries we are providing assisting, especially double tax treaty, then the withholding tax, corporate tax, and transfer pricing for their head office or head office having a office in UAE and branch in outside, we are assisting the client for that. So 31st January, UAE government has taken a step towards the corporate tax and announced that it is going to be launched soon. And as they have mentioned in public consultation document, which released on 20th April 2022, they have mentioned that it is going to be applicable from 1st June 2023 onwards. So there is a still lot of client are coming up with the questions how it is going to be applicable to them in the mid of the year. So the law says that it depends on your financial year. If your financial year is starting from January 2024, means Jan to December, so the corporate tax will be going to be applicable from 1st January 2024 onwards. Correct? So, and yeah, there are a lot of clients because there is no fixed financial year in the UAE. So some client maybe financial year start from June, July, September, and according to their convenience, they have decided and mentioned into the MOU. So client has to follow that. Most important part is October 2022. On the 3rd October, if you see the corporate tax law and documents date is a 03 October, right? 3rd October. There is a one important thing is that CAR's effective date of law, we call it. It is a anti-abusement rules. So what it means that need to be understood by everyone. Later on, we will go in detail. But overall, that if you are doing any restructuring to evasion of the tax, corporate tax authority may be disallowed if you are not able to justify. And this is not a new law. Yeah, new law for the UAE, but in if you see UK and other part of the world, in like India, it is since many years it is there. You can possibly restructure your organizations to minimize the law, but you cannot restructure for the evasion of the law. So that you have to always keep in mind when you do the restructuring. That's why it is very, very important for everyone. Final law published, as everybody is aware, from the on the 9th December 2022, and after long waiting period, they have released 9th October 2022. As mentioned earlier, it is going to be effect from 1st June 2023 onwards. Now, there is a still another executive regulation need to be published within short period. Date has not been announced, but that is the end point of the tax law, we can say that, and with the full clarity will be there in the executive regulations. So here they have published the articles, 70 articles they have published, and here we define your business activity and which article will be belongs to your business activity, which need to be identified for your business. So this is my opening remark about, and now over to Ayush Goel. He will explain you about the corporate tax in detail. Thank you very much, and thanks for joining again. And once again, Happy New Year to all. Have a nice day. Thank you.
Thank you, Mr. Bineet, for setting the tone. A very warm good morning to all the participants. Thanks for joining this webinar in huge number, and we can see that the counting is still going. Thank you for taking your time to attend this webinar. My name is Ayush Goel, and I will be taking you through to some of the important concepts of corporate tax to understand how the same shall be applicable to your business. So, we need to firstly understand what will be the applicability and scope of the corporate tax. So, all the residents in UAE in terms of the persons, including free zone entities that are established in UAE, they would be definitely under the ambit of corporate tax. All natural persons like you, me, including all others who are conducting business in UAE, whether or not they obtain license in UAE, they would be liable for corporate tax. All foreign juridical persons that are managed and controlled in UAE, in a sense that they have the place of effective management in UAE, they would be under the ambit of corporate tax, and any other persons that may be specified by the law. So, all these persons on the left side of the window, they would be termed as residents in UAE, meaning that their global income would be taxed in UAE, which is a big thing. On the right hand side, you would see that the non-residents would also get taxed in UAE, in three scenarios. First scenario is permanent establishment, which is one of the most important concepts which also exists in other part of the world. I would be covering this concept separately in the next slide. Apart from that, non-residents that are based outside UAE shall get taxed in UAE if they have the UAE sourced income. Also, if they have the nexus of UAE. What is the nexus in the UAE? Is, while the word seems very small, but the interpretation and meaning is wide. But one will have to wait for the detailed clarification to understand what will be the meaning of nexus going forward. There's certain class of people who would be exempt from corporate tax, such as government controlled entities, definitely. Persons that are engaged in extractive business, non-extractive natural resources business, certain investment funds that are qualifying pension or social security funds, charitable and public benefit organizations, and any other persons that would be classified, that would be specified ahead in due course. So these persons would be exempt from corporate tax and they would not be required to undertake corporate tax compliances. So going ahead, after understanding the applicability and scope, it is important to understand what will be the corporate tax rates that would be applicable to certain people in UAE. Since the introduction of corporate tax law, we have been hearing various queries from clients, including this query, as to what would be the taxability of free zones in terms of the tax rate, and all the taxable persons, what would be the basic exemption limit, etc. So to make everyone knowledgeable, taxable income up to AED 3,75,000 would be taxed at 0%. Important point to understand and mention here is that this exemption limit has not been specifically given in the law. We interpret this from the public consultation document. There this was given, as well as the FAQs that have clarified this again. However, this has not been clearly given in the law, and this amount needs to be confirmed by a way of a cabinet decision. All taxable income above AED 3,75,000 would be taxed at flat 9%. There's no incremental level of taxation that do exist in different part of the world. For a free zone entity, qualifying income shall be taxed at 0%. Non-qualifying income shall be taxed at 9%. However, very important and critical to understand and note here is that what is the meaning of qualifying income has not been specified in the law, and we await a detailed clarification in this regard by way of any executive regulation or a cabinet decision. Another important question that we have been hearing since the introduction of law is what will the large MNCs, large multinationals that cross a certain threshold, what will the tax rates that would be applicable to them? Public consultation document had highlighted that they would, they could be governed by the BEPS Pillar 2 framework. However, the final corporate tax law that was issued on 9th of December has not given any, has not thrown any light on this topic as to what would be the taxability of large MNCs. However, if one refers to the FAQs that are issued, one of the FAQs clearly clarifies that as of now, the MNCs would be taxed under the current taxation rates, that is 9%. However, we understand that with the implementation of BEPS Pillar 2 framework in due course in UAE, these MNCs who cross a certain threshold might very well get taxed under that taxation and would be liable for a higher rate of taxation, probably 15% or more. They've also come up with small business relief concept wherein the small businesses may opt to get taxed at 0%. That is, they might get opt to get out of the ambit of corporate tax. However, again, there's no thresholds that are prescribed for these businesses. What is the meaning of qualifying income? Again, there's no description about this in the law, and again, one will have to wait for the detailed clarification in this regard. Very important, and I would request everyone to be very attentive to this concept, is permanent establishment. Well, everyone would be aware that this concept is quite famous across the world and is quite debatable at the same time. Permanent establishment basically means that wherever non-residents that are based outside UAE carries out business activities in UAE without having any formal presence in UAE, then a permanent establishment would get established. So purpose of P, that is permanent establishment, is to determine and establish the presence of a foreign company in UAE so as to justify why the corporate tax shall be liable for them on the income that they earn through that PE. So we should understand what are the different tests to determine how a PE shall be established. So first is fixed place PE. On the right hand side of the window, you can see test for determination. Fixed place PE. This basically says that if a non-resident has any physical presence in UAE by way of an office, warehouse, factory, etc., any place through which it conducts business activity in UAE, And if other conditions that are mentioned in the law are fulfilled, then a fixed place P can get established for that non-resident in UAE. Similar to fixed place P, another test is dependent agent P, that is known as DA. So dependent agent P basically means that if the non-resident has a agent in UAE through which it deals with the external customers, the agent has the power to negotiate contracts, to conclude contracts, to negotiate the pricing of the final contracts on behalf of the non-resident in UAE. Then the income that is earned through that dependent agent might get taxed by way of a PE in UAE. Similar to that is construction PE, which is formed because of the construction activities that happen for a non-resident in UAE. However, important to highlight here is that an exemption that has been given to all the Ps that can get established in UAE is if the activities that are conducted in UAE are of a nature which are the supporting activities to the main income generating activities. So basically the activities that are conducted in UAE are of such nature that they are not core generating activities, such as storage of goods, display of goods, any maintenance of any database, etc. So these activities are of preparatory and auxiliary nature, and therefore they are not termed as core generating activities, and therefore they might get out of the ambit of permanent establishment. However, we would like to highlight that this is one of the very fact sensitive exercise and requires a detailed investigation to conclude whether a P is established in UAE or not. So what would be the possible implications if a PE is established? You would have to attribute to profits to the PE. You would be subject to corporate tax on that income that is attributable to PE. You would be required to obtain tax registration number. You would have to pay taxes, file return, and maintain appropriate documentation. So in essence, once a PE is established, you would have to undertake all the necessary compliances. Otherwise, that a judicial person in UAE is undertaken in respect of corporate tax law. However, since a concept is new to UAE, there would be certain challenges that would be associated possibly with the introduction of this concept. Again, attribution of profits to the P is a detailed exercise. One would have to, go into minute details and requires a lot of investigation to conclude what are the profits actually that are attributable to that respective P. How the domestic provisions that are worded in the corporate tax law vis-a-vis the provisions that are there in the tax treaties that are entered by the UAE government with the government of that respective jurisdiction, how the two would be interplayed with, and what we would have to look at which is more beneficial for the taxpayer in UAE, etc. Also, on one hand, there's a concept of permanent establishment. On the other hand, there's a concept of UAE source income. So UAE source income possibly is a wider concept, we can say, and one would have to determine how you interplay both the concepts. So again, very important concept going forward for all the non-residents. Again, another important concept, and what we are hearing since long is what would be the taxability of free zones. Just to take you all back a little bit, the public consultation document did highlight that any income that you earn from outside UAE, from other free zones, etc., from mainland, from your group mainland entities, etc., that might be under the ambit of 0% corporate tax rate. That is, they would be under the exemption criteria. However, I would like to highlight there is no such mention in the corporate tax final law that has been issued on 9th of December. So any qualifying free zone, so when I say qualifying free zone, it means a free zone that meets certain criteria so as to become qualifying. They would be taxed at 0% on the qualifying income that they earn. Again, what is qualifying income? Like I mentioned before, is yet to be clarified in a detailed manner. You would have to bifurcate your qualifying income and non-qualifying income so as to get taxed on the respective streams of income. There's an option that is given in the corporate tax law is whether to opt for the corporate tax or not. So free zones might opt to get taxed at 9%, that's the regular corporate tax rate. However, this option, whether it is irrevocable or not, whether free zone has the option to go back into the exemption regime or not, is still an ambiguity because PCD clarified that they might not be able to get back. However, there's no such mention in the corporate tax law. Very important to see here is that in order to get taxed at 0% or to avail the exemption criteria, the free zones are required to maintain adequate substance in UAE. When we say adequate substance, the substance should be maintained in form of assets, adequate employees who are carrying out the activities in UAE, having board meetings, having minutes in that respective entity, so as to understand that the decision making is happening in free zone itself. So it's not just earning revenue, conducting business activities through free zones. Equally important is to highlight is to make sure that the adequate substance is also maintained in UE. Apart from that, compliance with TP provisions, again, the free zone entity would be required to comply with transfer pricing provisions. Very important and mandatory condition to avail the exemption is auditing of the financial statement. So your financial statement needs to be maintained properly and needs to be audited if you're opting for the 0% corporate tax rate. Very important and critical is to understand the transactions, what would the treatment of the transactions with mainland entities, which is also one of the agenda of the today's webinar. Again, taking you back to the public consultation document, they specified that the transactions that you undertake with your group mainland entities may be exempt for you, however, the same gets taxed in the hands of the mainland entity. However, again, there is no such mention with respect to the transactions that you undertake with the group mainland entities. External mainland customers, how would they be treated as qualifying income? What would be treated as non-qualifying income? We would have to bifurcate the income that you earn through within free zones, through mainland entities, through group mainland entities, to external customers. And again, accordingly, once a detailed clarification is given in this regard by way of any decision or executive regulation, we would have to make sure what's the qualifying income and what would be treated as non-qualifying income. So this is in nutshell the scenario for any free zone entity. So we should now understand, how to compute taxable income. What would be the taxable income that would be liable for CT under UE? You have to take base as the net profit before tax as per the profit and loss statement. The profit and loss statements that are prepared under the generally accepted accounting standards and needs to be audited definitely. You have to take that as a base. You have to make certain adjustments in form of allowances, disallowances, incomes which are exempt, not exempt, and other certain deductions you have to take, and you arrive at a figure which would be further subject to corporate tax. So any dividend that you earn from local UAE entities, they are fully exempt. However, any dividend or capital gain incomes that you earn from entities that are based outside UAE, that is non-resident or foreign companies, there are certain conditions which are known as participatory conditions that are attached to that in order to claim exemption for that. You should be holding at least 5% ownership in that respective non-resident entity. The foreign company should be taxed at 9% or more. You should be holding the equity in that entity or the ownership in that entity for at least 12 months. That's the holding condition that they introduced in the final law. So these are the conditions for claiming exemption from dividend and capital gains from any foreign entity. Interest capping rules is one of the I can say one of the most important criteria you should take and you should keep in mind while you calculate taxable income. Any loans that you obtain from entities, public financial institutions, banking institutions, related parties, non-related parties, etc., any interest payment that you make is capped to 30% of EBITDA. EBITDA is earnings before interest, tax, depreciation, amortization. You have to calculate this, of course, from the audited profit and loss statement. So any interest payment that you make, this would be capped to 30%. However, the remaining 70% which you are not able to claim in a respective tax year, you're eligible to carry forward that in next 10 tax periods. So this is very important going forward. Tax grouping and losses, again, similar to VAT, they've also come up with a concept of tax grouping under corporate tax. But again, just to mention for everyone's convenience, since we are having this doubt since long, the grouping under VAT would be different from grouping under corporate tax. So grouping under VAT will not be considered as grouping for corporate tax. So there are certain benefits and conditions attached to grouping. So if you're forming group, you can file one corporate tax return, whether the transfer pricing would be applicable or not in terms of grouping, etc. Losses, if there's a group and there's loss in one entity, you're eligible to offset that loss with the profit of other entity within the group, provided other conditions are fulfilled. So tax grouping and losses would also be required to be considered while computing taxable income. Another important head is other income and expenses. So a golden thumb rule is that any expense that you incur not for business purpose, so that would not be eligible to be allowed. That would be straightly disallowed. Other important concepts that they have come in the corporate tax law is entertainment expense. So any entertainment expense in form of meals, accommodation that you incur, or any other fun expenses that you incur for customers, shareholders, etc., that is allowed only till 50%. That is, it is disallowed to 50%. Any donation or penalty that you make is 100% disallowed. Any bribes, any illicit payments, or any other payments that are of similar nature, that would be disallowed 100%. What would be the treatment of withdrawals from connected persons, etc. So, while this slide captures how to compute taxable income, but this is not it. You have to deep dive to every expense under the profit and loss statement and to understand it's for business purpose, whether it's inflated or not. And, vis-a-vis the last financial year, how is that picture coming out? So this is not a straightforward calculation just to take profit as per the profit and loss statement and just make certain adjustment and that's it. You would have to deep dive on every line item and see what will be the impact of corporate tax on it. So since the law is new for everyone, for us, for all the businesses in UAE, especially for federal tax authority as well, since the corporate tax law introduction is fairly new, there are certain practical challenges that we expect would be faced by a lot of businesses in due course. And just to mention that these are not the only practical challenges, these we interpret as practical challenges. There would be much more practical challenges than this once the final law is implemented. There's no threshold limits for the applicability of transfer pricing, which is one thing that we anticipate. Again, my colleague Alexander would take you through the transfer pricing in detailed manner after this. Allocation of expenses to exempt non-exempt income would be the key. If a free zone entity is earning both qualifying income, non-qualifying income, how are you bifurcating your expenses income in respect of the qualifying income, non-qualifying income? Allocation key would matter a lot. For the purpose of claiming any expenses, identification of capital and revenue expenditure is a very key exercise. Everyone would be aware that the debate of claiming capital versus revenue expenditure is existing almost every part of the world and is one of the most debatable topics, and we anticipate such debate in UAE as well. So you have to identify which expense is capital, which will not be allowed obviously, and revenue, which would be allowed certain to certain conditions. Any claim of foreign tax credits, so any income that you earn from outside UAE, if that is getting taxed outside UAE as well, and since being a resident of UAE, that income is also getting taxed in UAE. When it comes to double taxation, and if you're paying taxes in that jurisdiction as well, how we would be claiming that foreign taxes in UAE? What would the procedures? What would the challenges that you would face? Again, this is one of the very high debatable areas that exist in every part of the world where the taxpayers face challenges in terms of claiming of tax credits in actual manner apart from calculation. So we anticipate similar challenge in UAE going forward. The final law is specified that you can carry forward the losses that you're not able to offset in a particular tax year. What will be the procedures? What will be the mechanism to do that? Again, can be a challenge. Rules for determination of nexus. So again to reiterate, nexus being a small word, the interpretation is very wide. How would you determine nexus in UAE? Because it might be a case where every income can be termed as having nexus in UAE. So what would be the rules for determination of nexus? One would have to wait for a detailed clarification for cabinet in this regard. GARS, as Mr. Bini rightly highlighted in the beginning, how would the GARS be interpreted and implemented? To mention here is that there is no threshold that is being introduced by the UAE government in respect of the applicability of GARS. What with the minimum amount of tax evasion they consider that above that the entire arrangement would be considered as tax evasion? It is very important and critical going forward, and also a challenge at the same time. Whatever restructuring that you take, it should be I can say tax savings, or it should be done in a bona fide manner rather than being unethical and doing it for tax evasion. So how FTS look at this is a challenge. Last but not the least, another challenge can be any transactions that a free zone entities undertake with the mainland entities. If any corresponding adjustment because of transfer pricing or any other thing is been done in the free zone, a consequent adjustment needs to be done in the other related party as well. How would this be dealt going forward would be another challenge. So while this is not the only challenges, other challenges would also be there. we, considering the proximity of time, I could cover the maximum possible things. Apart from that, there are other administrative things such as, filing of return, payment of taxes within 9 months. There's no concept of advance tax. Withholding tax is zero at present. However, they might come up with rates going forward. So this is, in a nutshell, some of the important provisions from corporate tax law perspective. I hope this was an insightful session for everyone who's attending this webinar. I now hand over the stage to my colleague Alessandro, who would be taking you through to transfer pricing provisions, which is another important concept which would be introduced along with corporate tax. So over to you, Alessandro.
Yeah, thank you very much, Ayush, and hello everyone. I'm Alessandro Valente. I'm Director of International Tax and Transfer Pricing at CRO UAE. And today, as mentioned by Ayush, I will briefly touch on the transfer pricing regime that was introduced alongside the UAE corporate tax law. So, Federal Decree Law number 47 of 2022, as it is better known, UAE corporate tax law, contains, as a matter of fact, also several provisions in relation to transfer pricing. This was highlighted and preceded by the public consultation document from the 28th of April, as well as the FAQ and the announcement on the 31st of January. So more specifically, Article 34 and 55 introduced the concepts of arm's length and the documentation requirements respectively. And we will see these later in the presentation. In addition to this, Articles 35 and 36 also define the concepts of related parties and connected persons. So unlike the corporate tax regime, the UAE transfer pricing regime will be based on the most recent OECD transfer pricing guidelines. This provides us with a great advantage because it gives us a high degree of certainty in terms of what we can expect from the transfer pricing regime in the UAE. This has been, again, specified both in the FAQs and in the public consultation document. However, before we dive into the relevant TP provisions, I would first like to do a quick refresher of what transfer pricing is. So we can, on to the next slide, thanks. So to put things into context, as M&E groups operate in multiple states, this naturally poses numerous challenges for policymakers and tax administrations of the states in which these M&Es operate. In this regard, states generally seek to develop and administer tax policies that provide for the taxation of profits that arise in their territory, while at the same time limiting the potential for double taxation or negatively impacts their economy and more specifically foreign investment and international trade. So due to their preferential relationships, members of an M&E group are generally naturally be able to both naturally and artificially establish special conditions in relation to their intra-group transactions. These conditions often differ from those that would have been established had the group members been acting as independent parties that are operating in open markets. As a result, the pricing of these intra-group transactions may not be objectively determined, and in certain cases may also be subject to a level of manipulation. So this is of particular importance in the context of direct taxation, since the prices that are used in intra-group transactions have a direct impact on the allocation of profits within the M&E group, and they in turn impact the taxable income in each of the states in which the M&E group operates. So in the next slide, we'll see how, in order to address this, an increasing number of states, I would say the majority of advanced tax jurisdictions worldwide, have introduced specific legislation which addresses transfer pricing, and it seeks to protect the tax bases we've just discussed, while at the same time minimizing any negative impact on, for example, foreign investment and international trade. So in this regard, most states have adopted the so-called arm's length principle as the basis for the provision of their domestic legislation that aims to address transfer pricing matters. As per the OECD transfer pricing guidelines, which we have said are the basis for the regime, the TP regime in the UAE, the arm's length principle prescribes that transactions should be valued as if they had been carried out between unrelated parties, each acting in his own best interest, or, as we previously mentioned, at market value. So, in this example, let's assume that Revco, that is a resident in State A, has provided a technical service to its sister company, that is Topco, who is a resident of State B, and that Revco has not charged Topco for this service, despite the fact that Topco would have otherwise paid for the service had it been obtained from an independent party, such as Company A. So in this scenario, it is clear that the commercial relations, the preferential relations between Revco and Topco differ from those that would have been applied between independent parties. So the application of the arm's length principle to this scenario essentially requires that the profits that would have accrued to Revco should be included in Revco's profits and taxed accordingly. So on to the next slide, please. So in the next two slides, we will touch upon the concepts of related parties and connected persons, which are the core of or one of the pillars of the transfer pricing regime and how transfer pricing essentially functions. So in reference to Article 35, which delineates related parties and control, a related party is defined as an individual or an entity who has a pre-existing relation with a business that is within the scope of the UAE corporate tax regime to either ownership, control, or kinship. And obviously, in this case, we're talking about natural persons. So the rules for determining whether parties involved in the transactions are considered related parties for UAE CT purposes are the following. You have them on screen. So the first one is when two or more individuals are related within the fourth degree of kinship or affiliation, including by way of adoption or guardianship. The second, when an individual and a legal entity were alone or together with a related party, the individual directly or indirectly owns a 50% or greater share in the legal entity or controls it. The third is when two or more legal entities, where one legal entity alone or together with a related party directly or indirectly owns a 50% or greater share in the legal entity or controls it. When a taxpayer and its branch or permanent establishment. And in the case of partners in the same unincorporated partnership. In the next slide, we will instead see the concept of connected person. This is Article 36 for your reference. And as per the UAE corporate tax law, a person will be considered as connected to a business that is within the scope of the UAE corporate tax regime if he or she, obviously here we're talking about natural persons, is an individual who directly or indirectly has an ownership interest in taxable person or controls it, a director or an officer of the taxable person, a partner in an unincorporated partnership alongside any other partner in the same partnership, and then finally, similarly to Article 35, a related party of any of the above. So continuing with the next slide, we will now tackle the transfer pricing documentation. This is obviously one of the most relevant points for businesses. We will see how it is essentially a compliance at this point, just based on how it was going to be prescribed by and enforced by the FTA. So as you'll see in the slide, the documentation requirements are prescribed in three ways. We have local file, master file, and related party disclosure form. This is in relation to Article 55 of the law. And subject to what we believe will be a revenue threshold, and this is a point that has not been yet revealed, but from my experience, this is usually the type of threshold that is used. Businesses will need to prepare and maintain a master file and a local file. In addition to this, they also may be required to submit a related party disclosure form. So starting with the master file is usually filed by the ultimate parent entity of the group and includes the organizational structure of the group, a description of the M&E businesses, a list of the M&E's intangibles, the M&E's intercompany financial activities, as well as the M&E's financial and tax positions. Talking about the local file, the local file is instead filed by each other entity of the group and includes a local entity section where we include a description of the management structure of the legal entity and a local organization chart. In addition to this, we have a detailed description of the business and the business strategies that are pursued by the local entity, as well as a list of its key competitors. We then have a control transaction section, which is the core of the local file, which includes copies of all material intercompany agreements, the detailed comparability and functional analysis, and an indication of the most appropriate transfer pricing method with regard to the specific category of transaction and the reason for selecting that method. This is very important, the rationale behind the selection of the method. And then finally, we have financial information section where we have the local entity's financial accounts, information and allocation schedules showing how financial data used in applying the transfer pricing method may be tied to the financial statements. And then finally, summary schedules of the relevant financial data for comparable use in the analysis. Finally, we have the related party disclosure form that we mentioned earlier, which contains the information of the transactions with related parties and connected person as per the parameters that we mentioned earlier. Interestingly, it must be said, as per Article 55, TP documentation will have to be submitted to the tax authorities within 30 days following a request by the authority itself. So unlike other jurisdictions, the UAE will not require UAE entity to file the transfer pricing documentation that we just described, but simply to maintain it. Now, we have received multiple queries in this regard, with clients asking whether it would be at this point necessary for a company to invest in such burdensome exercise. And the response that we most often give our clients is that essentially this 30-day brief window that the UAE authorities have provided had the practical effect of transforming such TP documentation into an annual compliance. The reason for this is that although there is, as I mentioned, not an express requirement for the entity to file the TP documentation, the brief window that is provided to the taxpayer to submit such documentation will force the UAE entities to draft, if non-existent, or maintain, when once drafted, such information in already available format. You might imagine that a group with all of its complexities might not be able to gather the information and produce hundreds of pages of documentation that provide the rationale for each of the transactions that it is engaged, depending on the complexity, obviously, of the transactions in question within that 30 days very brief window. So proceeding on to the next slide, we have seen how previously how TP regulations will likely be applied to transactions which are cross-border in nature. This is, in fact, the very idea of transfer pricing. But the corporate tax law, the UAE corporate tax law, has also specified that they will always the regime will also be applicable from a domestic point of view. In addition, among the prerequisites for a free zone entity to continue benefiting from the 0% tax holiday that was mentioned earlier, the UAE corporate tax law states that such entity should comply with the TP regulations as per Articles 34 and 55, which is the arm's length principle and the documentation respectively. So given that the tax incentive provided to free zone entities and the applicability of transfer pricing in a domestic context, UAE mainland entities could, for instance, and keeping in mind the previously mentioned Article 50 on the general abuse rule, as an example, route their sales through their free zone entities in an attempt to save taxes. In such a case, and in other cases of similar nature, when applying the UAE transfer pricing regime, such transactions between related parties will have to necessarily be at fair market price value. And as it is the case in several countries worldwide, tax authorities often deny the tax benefits to free zone entities if their transactions with group companies are not at arm's length. So from the UAE perspective, such non-compliance will likely lead to a disqualification of the 0% tax rate in respect to the entire income of the free zone entity. On this note, I would also like to point out that in Article 42, Clause 1, there is a provision for the elimination of transactions in between the parent company of the group and each subsidiary that is a member of the tax group. And this is reinforced by FAQ 103, which is available on the UAE Ministry of Finance website. I would also like to mention that although the FAQs are extremely useful in obtaining an interpretation by the UAE tax authorities, specifically by the UAE Ministry of Finance regarding certain more obscure provisions of the corporate tax law, they have in no way a legal standing, and therefore they should not be relied on. They're just there simply to aid us in a further understanding of the corporate tax law. So a similar outcome, just going back to what I was saying, a similar outcome for free zone entities was also previously mentioned by my colleague Ayush when he talked about the importance of substance requirements in order for free zone parties to maintain the tax holiday benefits. So I invite you all to get a detailed list of what these parameters are, but they include both substance and transfer pricing, and they should be followed very strictly. If you know, for whatever case you happen to have entities in the free zone. So finally, on to the last slide, the expected practical challenges. So obviously the introduction of the TP regime, likewise the introduction of corporate tax will hold a certain amount of challenges for businesses. First and foremost, the absence of transfer pricing in the entire region, with the exception of Saudi Arabia and Qatar, which in many ways have introduced transfer pricing quite recently, has essentially created a shortage of transactions that can be used as comparables during a TP study. Fortunately, the OECD transfer pricing guidelines indicate that in the absence of sufficient comparables, the search can then be extended as long as a valid reason can be provided. Secondly, given the subjective nature of the arm's length method, there is also a chance that the FTA, or the UAE Federal Tax Authority, will challenge whatever TP methods are chosen by entities in the UAE. And because of this, it is obviously necessary for UAE entities to build ahead a solid documentation that can provide the rationale behind the choice for such method for that particular group of transactions. A third practical challenge that we foresee is also the level of economic substance. We mentioned it earlier multiple times that is expected from the UAE Tax Authority in relation to TP and free zones. However, as of the present date, there has not been a clarification in regards to this point. And finally, the absence of TP could have the effect of catching UAE groups, or at least the absence of TP so far in the UAE, could have the effect of catching UAE groups of companies unprepared when it comes to the documentation of intercompany transactions. So as mentioned previously, the time frame for providing information to the FTA, if requested, is extremely short, 30 days. This essentially forces companies to map their intercompany transactions, draft intercompany agreements, draft and review their documentation on a cyclical basis in order to avoid non-compliance, penalties, adjustments, and anything that might follow thereon. So I would like to thank you all very much for your time today. It was a pleasure. And I will now leave the floor to Marcus Suzilo, who is our head of tax partner, for the closing remarks. Thank you very much.
Well, thank you, Alessandro, and thank you all for still staying with us now for this. Ayush, can you please go back to the last slide? No, but I just want to give some summaries. I mean, as you can see here, there are quite some practical challenges, but one needs to look back as well in terms of the actual reasoning as well of this corporate tax that has been published here. Now, when the law itself was published, actually, I saw quite a similarity to certain concepts within the OECD PEPs as well, and I see that in this case the UAE is fulfilling or is in alignment with its commitment as being part of the OECD inclusive framework on PEPs, on base erosion and profit shifting, right? And as mentioned by my earlier colleagues as well, if you look at the GAR, the general anti-abuse rules, that is basically similar to what we have in the PEPs Action 6. And as Alessandro was mentioning and also giving the presentation, when it comes to transfer pricing, it becomes even more and more important. And if you go back to the 15 PEPs action, that would be in alignment with PEPs action 8 to 10. So I think with this corporate tax, we do expect that the UAE is basically is operating globally also at par with the international best practice when it comes to taxation. And another thing that I've seen that would be interesting, especially for those of you who are active in the international taxation matters, because at the end of the day, the UAE is a global business hub, which means that it is naturally that, let's say, most of the companies that are operating here, whether you are located in the free zone or mainland, you will have somehow cross-border transactions, right? And the introduction of the corporate tax will give much more clarity on certain concepts that actually that is basically being described within the double tax treaties between the UAE and other countries. And by the way, at this point in time, the latest information from Ministry of Finance, approximately 137 countries that the UAE have the double tax treaty. Right? Such as if you look at certain provision about permanent establishment, which is very interesting as well to look at it, and how the place of effective management, especially when you have a structure where it involves certain offshore jurisdiction, and in reality the management is actually in this country. So one needs to be a bit mindful going forward in terms of looking at whether such operation is also subject to taxation in the UAE. Because now that the UAE implement the corporate tax, which means that the UAE will also assess even further what is the actual taxation, right, of the UAE government when it comes to any cross-border transaction. And lastly, and I would like to also let's say reiterate what Alessandro was saying, is that the Ministry of Finance has issued this frequently asked question. And if you look at in the first few sentences, or in the first few, in the first paragraph or first few paragraphs of this frequently asked question, one needs to be mindful of referring to such frequently asked questions, right? It is meant to be a guidance only, and they even mentioned that it is not a legal or tax advice, and it needs to be looked at in the specific fact and circumstances of the let's say of the taxpayer, of the company, of the situation. So again, currently we already have the corporate tax law that is issued, but we're still waiting for the further, let's say, something similar to implementing regulation in the form of maybe cabinet decision, and by then a lot of concept will then be even more clarified. But one can already start looking at what would be the impact to their business, especially when it comes to the transfer pricing. That's the reason why also Alessandro was mentioning, yes, it is very clear in our let's say in our corporate tax law that it will orient itself to the OECD TP guidelines, the OECD transfer pricing guidelines, which currently there's already a couple of let's say more or less clear method on how certain transaction between related parties or connected person can be assessed. So again, well, from our side, thank you very much for attending this this webinar. This is not the first and the last, but we will have more and more, let's say, webinar series on these topics, because again, corporate tax is a vast, massive topic as well, and we're planning to also, you know, have some webinars also on the industry specific. Yeah, I think that's all. If you have any questions, so I use, can you go to the last slide? So if you have any questions, then we are here to support you. Then there is our contact details there. Thank you very much.
One last thing I would like to add, we will send you some survey link to you for our feedback, and please, we are expecting response from you, so we can plan our next webinar according to that. That's what I would like to add. Thank you, Marcus.
Okay.
Thank you, everyone.
Thank you. Bye-bye.
Yeah, and once again, Happy New Year to all.
Thank you, everyone.
Thank you. Bye.